Welcome to the Courtiers Quarterly Market Update podcast, where we're talking with Jake Reynolds, Asset Management Director, and Head of Asset Management and Fund Manager James Timpson, to help us understand how Courtiers funds and markets have performed throughout the third quarter of 2025. Welcome to you both. James,
Hello, Leo.
Generally positive returns?
Yeah, it's been another busy quarter, but the key headline really is that equity markets have continued to push on. They've had another positive quarter, and it continues what's been a really positive year overall. So far this year, the growth fund has returned 12.6%, the balanced fund has done 9.7%, and the cautious fund has returned 6.9%. It's been a really positive year. And one of the things that's done particularly well recently is the good old FTSE 100, which tracks large cap UK stocks. And we have exposure to that index through futures, which gives us simple direct exposure, and also call options as well. Because the implied volatility on the index has been so low recently, we've been able to buy call options fairly cheaply. One of the biggest movers in the index recently has been Fresnillo, a precious metals mining company, which has done really well lately simply due to the rally in gold and silver prices. But one of the biggest contributors overall, just because of its size, is HSBC. It's been a really good year so far for financials and banks, and there's quite a few of those in the FTSE 100 index, which is why it's done so well. But equity markets in general have been performing strongly.
Well done to you and the team. Jake, lots of pluses, also a few minuses.
Get the short straw. So we look at contributions and detractors all the time, and we're looking at the fund every minute of every day. But we do look at the broader time frames as well, and doing this quarterly gives you an opportunity to sort of break the year up and look what's been driving and what's been detracting from the funds. What's at the bottom is lots of rate sensitive stuff. So, and for different reasons. So what is detracting from the portfolio? Obviously, James, has given those very good positive returns. Yeah, they're small negatives, but positions in long bonds, despite the Bank of England cutting rates, government borrowing has the rate at which governments can borrow has continued to increase, and that's partly due to inflation and credibility in the government and debt levels.
Well, one of those minuses, which Gary's been talking a lot about, long-dated bonds. And in your report, you mentioned long-dated gilts falling minus 2.39%.
Yeah.
So how does that relate to what Gary's talking about?
Gary's very much looking at those rates rise and going, okay, now this is starting to get attractive. And we're doing a lot of work at the moment on looking at how we can add them into the fund, what 10 years we should buy, so what duration we should buy so that it complements the existing holdings that we like. So joke is that we're sometimes a couple of years early to some positions. Some positions have done really well this year, such as Germany and banks positions. We had the Eurostoxx banks. We actually bought that in 2023, and you buy them when they are, not questionable, but they're at really attractive prices. And we picked up banks positions post Silicon Valley Bank going down, and also picked up the DAX when Germany looked really cheap, because obviously it was the Russia conflict and they're very energy dependent, and then they couldn't get cheap gas anymore, and big industrial economy, so that was not good for them. But then they pivoted, and they started within months they started using liquefied natural gas, and it's quite incredible. And so we started to build a position then, because you go, well, they will eventually get out of this. It's just a guarantee. So and that's why so we buy that position then. And so Gary's looking at those rates go up,
So that minus 2.39 is a good opportunity to buy.
Exactly. So bonds, when the prices go down, rates go up. And so when you're saying, the rates are really attractive, it means the prices are going down. So if you've got a 30-year bond that's trading at 70p, and you get a coupon with that, and then you'll look at all the movement, eventually it will mature at 100. So you'll look at the movement towards that and the coupon you get along the way, and that will give you the yield. So if that price is going down, that 70p, that means that yield is going up. And that might be a combination of pull to par, so that movement to 100, and the coupon.
So while it looks like a negative, it actually reflects positively.
If we buy them at this prices, and that's what we're looking to do, to move into some more long dated bonds. But we are we always say, equities are going to deliver that wealth generating power. The soundbite, the rule of thumb is that equities do around 6% real return for like the last a couple of hundred years, and that's what really drives your wealth creation. Real return on government bonds at the moment is about 2%. It's good, but it's not 6%. And so we prioritize the equity portion of the portfolios first, and then we will look at how we can fill the other elements, particularly on the cautious fund, that 40%. And as James talked about last quarter, what do we fill that other part with? That's got some infrastructure stuff. We've got some bonds in there. So we can then use that to build up a portfolio, and that stuff needs to go so not in line with the equities. And because there's been some positive correlation recently, we're not getting that complement with the fund. So we need to work on that and find out what the best ones to buy are. But we're very active in that space at the moment, and I think we'll be pulling the trigger soon.
Thanks, Jake. James, we always like to dig into the assets and see what you and the team are choosing to invest in on behalf of our clients. Is there anything new this quarter that's gone into the funds?
Well, one of the things we've increased in the last few months is our Japan exposure. We've done that through an index called the Topics Index. And this is one of the biggest indices in Japan. It has more than 1,600 different stocks in it. So just having this position in this index gives us exposure to a huge, broad collection of Japanese equities. And we've bought this index, and it's actually done really well in the last quarter. The index has risen roughly 10%. And this position also accompanies our exposure to individual Japanese equities. So these are stocks that have been initially chosen for us through our quants model, which we also use for the equity funds as well. So we now have exposure to Japan, both in a broad sense through the index position and also in a more concentrated way with a few stocks as well. So that's done really well. We've also added to our emerging market portfolio. We recently bought another South Korean stock, Kia, the car manufacturer. And emerging markets now make up about 7% of the growth fund, slightly less imbalanced and less still in cautious, because obviously they're risky positions. So we've been looking to mix up our emerging market portfolio as well.
James, thank you. And you mentioned in the report some areas in geopolitical and macroeconomic concerns. Jake, could you remind us of some of the challenges that you face when you're looking at investment decisions currently?
Yeah, I mean, news seems to be endless at the moment, especially with President Trump in power, just because of the way that he delivers announcements. So it keeps you on your seat. But you have the tariff still burning away. We're yet to see what impact that will have on the US in terms of inflation. People don't think it's actually manifested in the US inflation numbers yet. They think that the initial shock has come to margins in US companies on the tariffs. There's still we're in the middle of a 90-day hiatus with the negotiations between the US and China on what their final tariff rate is going to be. China actually had a really good quarter because they felt that the impact of these tariffs has not been as great as once feared, but actually they're still in this period. So we proceed with caution. We've got one stock in Hong Kong, but we're not looking to build that China exposure despite a strong quarter, because ultimately for the last 18 years it hasn't really done much, and you worry about how the government controls their capital allocation. So you've got those two massive economies going toe to toe with each other. So that's a really dominating factor, and there's things that we keep in touch with constantly because it has such an impact. And you can see that with, the UK was the number one fastest growing G7 economy in the first half of the year. But some of that was due to the tariff impacts, people stockpiling to get in front of tariffs. There was the stamp duty cut off. So that accelerated some activity into the beginning of the year. So you see how a policy impact on the US can affect the UK. So we have to keep in touch with the UK. We have to keep in touch with China. You've still got all the stuff going on in the Middle East. Luckily, that's not affecting oil, which we spoke about last quarter. which continues to fall, and that's half the price it was at the sort of peak in 2022. So it's really all of those things that are on the radar at the moment. And then you've got Russia and Ukraine, which continues to be a big factor. And then that's pushing Germany to spend more on defence, which has helped our DAX position. So you've got all this stuff going on all the time, but that it never ends. I think, we open the report with the never-ending cycle of macroeconomic and geopolitical risks.
Yeah.
And I think we wrapped up last quarter with, markets climb a wall of worry, and if they're going to keep climbing, bring on the worries. And I think that's very much the same this quarter. But yeah, I think that's a taste. You can get the long list as well, don't you? I think, Q1 update, we opened with a list of all the geopolitical macro concerns. Took about 5 minutes to do the opener, right?
Just daily business, isn't it?
Yeah, exactly. Yeah. But yeah, there's a lot going on, as James said. Busy quarter, lots going on, lots moving the portfolios. But you've got to pick up things at good prices. Invest where capital is scarce. Sometimes that's scary. Diversify, and we'll get through it and report on it as it goes.
We've made clear your views on China and actions forthcoming there. How about the shining question of precious metals and their performance?
Yeah, so should you have gold and silver in a multi-asset portfolio? I think some multi-asset managers will say yes. We like productive assets that will build wealth, and I think data is on our side when you look back at the history of real returns of gold and decades it can have when it doesn't get a return at all. Gold between 1983 and 2007 had no return whatsoever. And then it's not only that it had no return, what did it take the place of? Something that an equity that was doing 6% real return or something like that. So it's not a way to build wealth. Bonds, government debt and cash sit in front of it, and then equities are way ahead of it, and that's what we favour. We'd rather get that right.
You're saying it's just too risky given its long-term performance?
Why is it going up at the moment? It's because China's buying. Because it doesn't want to hold, the central bank's buying because it doesn't want to hold US Treasuries anymore because of this tension. So going back to your geopolitical risks, and also retail investors in China are buying because all the property's blowing up. This is what happens when governments direct capital. They directed capital to property investment. That's all left a sour taste in people's mouths. They're not as in tune with maybe equity markets as many maybe investors in the UK or US are. So they've gone to gold, and then gold got pushed to such a high level that as a ratio to silver, it had gone 100 times more expensive than silver. So normally that level has been around 50 for the 20th century. The Romans, I think, set it at 12 times back hundreds of years
so it's
ago.
Expensive to buy as well.
Exactly. But then eventually people go, well, gold is so expensive, let's look for alternatives. And that's what's pushed up platinum, and that's what's pushed up silver. So that's come purely from China. So you can't really model that stuff. And it's not stuff that you'd be trading themes rather than fundamental value and data. So it's there's times to be thematic, but you've got to do it with value on your side.
Sure, it's too turbulent for the kind of investing that we do in wealth management.
And I feel like it would be a ballast in the fund at a dead weight. But there is rationale. I do agree with what JP Morgan originally said in 1912. The original JP Morgan, not the investment bank, the founder of the investment bank, said gold is money, everything else is just credit. And the way that money gets created through the banking system, I can see why he would say that. And you've got gold. There's only enough gold in the world that would represent 35 double-decker buses. So you can create some scarcity and then create a currency off the back of it. So I can see why people maybe would have some sort of apocalypse fund or some, it's meant to be a safe haven asset. But the reality is it's trending up with equities right now. So it's not providing that correlation. And it's the same problem we have with bonds, isn't it? Is that they're correlated at the moment because everything went down in 2022 with the Russia-Ukraine invasion. So we've got to work through that and find out how we can make sure that we can find uncorrelated assets to sit alongside the equities and complement them, not just be a dead weight. And that's why we favour infrastructure and bonds over commodities. And lastly, the super cycle of commodities, right? If you go, well, let's diversify. There's some equity markets that have not returned a positive return for decades. Japan, we've gone back into, but that's just gone to an all-time high. that's taken 34 years to surpass its 1989 bubble. But you can buy a bit of Japan, you can buy a bit of Korea, you can buy a bit of the UK, Germany, and that will eke out 6% real return. You don't get those lost decades when you diversify across the globe. But so you buy one commodity, you diversify across commodities, you buy maybe a bit of gold, bit of silver, bit of oil, bit of copper. But the super cycle in commodities is down. People find cheaper ways to extract it. They find cheaper ways to produce it. So it's not like you can sit on a pool of commodities for decades and hope to retire rich at the end of it.
Sure. Thank you, Jake. Very, very interesting. James, we've reported positive returns across the Courtiers funds. How confident are you feeling that this will be the case come December in the client seminars when you're up on your feet?
Well, because it's been such a healthy year so far, there'd have to be a fairly drastic downturn in the next couple of months for us to not be presenting positive returns in December.
Sounds sensible.
Yeah. Well, you never know. You never know. But touch wood, we will end the year with good positives.
Thank you. That's great. Well, thank you both again for your time and your insight into the Q3. I'll look forward to seeing you both. Well, the seminars.
Seminars, yeah.
Yeah.
And
Look forward to seeing all the clients.
Yeah, next quarterly report in January 2026. And I'll see you next month, James.
Brilliant. Thanks, Leo.
For the November update. Last one of 2025. Flying by. Thank you both very much.
Thanks, Leo.
All right, take care. Thanks for listening. If you have any questions, please do contact your Courtiers advisor or drop us an email through the website. And if you've enjoyed listening to this or found it interesting, reassuring, follow us.